Hi, good morning, everyone. In today's webinar, we will talk about some company results as well as our Singapore REITs sector report. The first one is CNMC Goldmine Holdings Limited. Last week, announced the third quarter and 9 months results. We maintain our core buy with target price of $1.01 compared with previous $1.03. And its last close price was around 50 cents. Now let's look at the financials. The top line revenue went up by 8.5% in 9 months to $29.5 million. The moderate growth was due to 4.8% year-on-year growth in the average realized gold price, as well as 2.9% growth in production and sales volume. Here we will talk about the 3% growth in production volumes later, and the operating profit, it grew strongly by 45%. It was due to the appreciation of US dollars. And now let's look at the bottom line, the net profit. It went up by 46.6% to around 14 million. Again, it was due to it was in line with the strong growth mentioned above. Here is the breakdown of the top line, the revenue. As you can see here, during the 9 months this year, the average realized gold price was reported at $1,255 per ounce, compared with last year's the same period of around $1,200 per ounce. And also the production and sales volume in 9 months this year was reported at 23,363 ounces with 2.9% year-on-year growth. So here, the moderate growth was due to the suspension of operations in the third quarter. Lasted for 21 days. It was due to the stop work order because CNMC applied the large-scale operations and extend its mining license for another 20 years from 2018. So during these 21 days, the average spot gold price was traded at $1,342 per ounce, and based on our calculation of normalized daily volume, year to date, it was around 94 ounces per day. So we can basically calculate the revenue of $2.6 million if the stop work order didn't incur. CNMC could have made another 2.6 million in the third quarter. Also, the all-in cost will shoot up due to the 5 million of payment for the mining lease extension. So in the third quarter, CNMC had paid $600,000. So, and the remaining $4.4 million will be paid off in the fourth quarter. So based on our estimation, the all-in cost in this year will increase a lot. It is estimated to be $746 per ounce in this year.
Morning everyone, Peter here. GLP reported its results last week. So what did we do to it is we revised our target price upwards by 3 cents to $2.31, and the last close was $2.08. So just a bit on its performance here. Revenue was up, EBIT up, PATMI was up as well, and finally PATMI was up 52% to $173.1 million US dollars in the second quarter of 2017. And it pretty much came into our expectations for our forecast. So the stronger PATMI was driven by higher development margins. It came in at 30%. It exceeded their, this is their own internal expectation of 25%, but we have maintained 30% in our own forecast. And we think that is most likely sustainable for the rest of the quarters. So for our own forecast, for my forecast at least, for the rest of for the full year of 2017, I use a development margin of 30%. Now, why this is actually important for us to note is that the stronger operating performance here is driven by higher demand for logistics space in China, and now just within 1 or 2 quarters, the outlook for China market is turning bright. On operating level, new and renewal leases were up 32% quarter on quarter. Customer retention was up 8 percentage points. Effective rent on growth and renewal leases was up 6.3%. And finally, lease ratio sustained at the 87% mark. And why is this important is, if you recall, 1 to 3 quarters ago, we were talking about a declining lease ratio. So investors were concerned back then when lease ratio kept dropping from the high of around 91%, it dropped all the way to 87, 86%. So at this juncture now, it's sustaining 87%, and we think that moving forward, you should see a lease ratio 87% for at least for the next few quarters or so. Now, renewal rent growth is also expected to grow for 6% for the remaining 17% of leases that will be expiring for the rest of 2017. Now, let's come back to lease ratio. Why we think that it will continue remaining stable is that because in the second quarter of 2017, GLP has started US $406 million of new developments. So this represents at least 30% of their FY17 target. And these new developments are started in the strong areas or strong markets in China. So these developments are started with at least a lease ratio of 92% onwards. So 92% is at least 5 percentage points higher than 87%. And moving forward, sustaining the current lease ratio of 87% is almost a no problem at all. And finally, for GLP, the management has become clearer about their plans for monetization of its China assets in its portfolio. And while they updated that it's still in negotiation, but this time around they've committed a timeline, a time frame that is in the next 6 months. So we should expect an update from them in the next 6 months. And you might remember that I talked about these 2 quarters ago, saying that the monetization of China assets is on its way. But then again, yes, correct, there were some delays, but think about this, there's no need for them to rush. Why is it so? Because just within this quarter, they are guiding cap rate compressions. So essentially, the valuation of these properties is expected to go up. And next thing is, they have no rush to sell it because the balance sheet still remains very strong. Gearing is at 14.8%, matched to an internal target of 40%. So essentially, they still have around 25% points to leverage upwards if they require it. So at the end of the day, you don't need to. If you don't need to you're not in a rush to sell things off. Furthermore, there is you're expecting higher valuation, so why sell now, right? And now next we move on to city developments. Okay, same thing here. They reported their results last week. So all 4 items are up, and for their profits is 60% higher than year on year compared to third quarter of 2015. For the third quarter of 2016, profits came in $170.3 million, and this was driven by higher contribution from the property development segment. Now, we maintain our target price of 998. TC still remains, so it's still a very strong player in the CCR segment, the core central region. And now we dive deeper into the core central region. So last quarter, when we talked about Gramercy Park, so this is a luxury development located on Grange Road, a D10 property. On the streets, people were were not too positive about its launch because of the lackluster demand in the luxury segment. But what they have done is they have actually done a soft launch of Gramercy Park. They launched 40 units, and within a quarter, 38 of these units were sold, and at a pretty good average selling price. And the average selling price for this development was $2,600 per square feet. While it was slightly lower than their projections, but they are still very strong in the margin. And $2,600 is still much higher than own projections. So this is definitely a bonus. So moving on from Gramercy Park, they actually still have another development that is not launched yet, which is on the same, is within the vicinity of Gramercy Park or along Grange Road, which is New Futura. It's a 174 unit luxury development also. But then again, we are not expecting it to launch soon because of at least until supply becomes tighter. So why is it so is the adjacent development from New Futura, which is OUE Twin Peaks. There are at least another 51% of these units to remaining unsold. So for OUE Twin Peaks, the developer, which is OUE, has been constantly reducing prices. So if they launch right now, they will go into a price war. And as also because of the vicinity to Gramercy Park, it will also add on competition with its own development. So what is important to know about New Futura is that QC only comes in late 2018 or so. So essentially, they still have quite a bit of time or buffer in order to clear these units. And now we move out a bit to the RCR segment. And during our initiation presentation, we mentioned about Commonwealth Towers and the venue residences. So this quarter in 3Q, there is still not much significant price cuts into these two developments, even though we are expecting them to cut prices. So why are we talking about price cuts is that, and again, a bit of recap, Commonwealth Towers and the venue residences are facing their ABSD due date soon. Commonwealth Towers is in the beginning of 2018, while venue residences in September 2017. So essentially, it's as close as 9 months or so before they have to start, before they have to finish clearing everything. And as for Commonwealth Towers, just a bit of just a bit of sharing here. Beside Commonwealth Towers, Queen's Peak was launched 2 weekends ago. Sales came in rather encouraging, around 33%. And ASP was around $1,600 per square feet, and this is significantly lower than the ASPs that were locked in for Commonwealth Towers for the first 51% of sales coming from this development. So what is important to note over here is that what is good to note also is because of the first mover advantage that CDL has. I mean, at the end of the day, Commonwealth Towers have already moved 51%. The remaining development has 49% or so to be cleared. Even if they start cutting prices, they will still lock in a higher average selling price compared to Queen's Peak. So I think moving forward, you can expect some price cuts. And for us, we've already taken that into consideration, and we are not going to reduce our forecast for that, at least for now. Now, the venue residences that came in, the sales performance there was encouraging. Right now, it's very 60-70% sold, remaining 20-30%. And at the same time, venue residences have not even cut prices yet. So for the remaining 20-30%, it's I would say that the development is very strong in the money. So no concerns as of now. And a bit of updates on South Beach. All the retail and office units have already been fully leased. And for its hotel operations, it's expected to begin in 2 months' time in January 2017. So for South Beach is a mixed development, has retail, office, and hotel operations, plus its residential component. And CDL has shared that they have no rush to launch its 190 unit. Again, just a bit of recap. It was shared that during CDL's initiation presentation, the management was given an offer for a per square feet price of 2,500 north for these penthouse units in South Beach residences, where they didn't even consider the offer simply because they expect higher prices from these units, or higher prices to that they can, or essentially these units are able to fetch higher prices. Next thing is that why are they not in a rush to sell them? Is at the end of the day, this is a mixed development, so it's not subjected to any of the ABSD or QC clauses. We move on to this international property development segment. So sales in China residential projects continue to gain positive momentum. And for its Hong Leong City Center in Suzhou, it sold 156 units of their phase 2 launch within an hour of launch. So 156 units represents around 30 or 40% of this total available units in the development. And again, we expect Chinese projects to continue this good sales momentum because of the favorable locations and the improving macro developments in the cities that CDL is exposed to, for example, Chongqing. Now move on to Hock Lian Seng. Hock Lian Seng's performance came in pretty much in our expectation, but because of this one-time gain of $5 million, as well as slightly higher gross margins from the civil engineering projects, PATMI it exceeded our forecast by 9 percentage points or so. And the thing to really note here is that we expect earnings to bottom in the whole year of 2017. So, and because of that, we've actually revised our target price, and we've upgraded our call from previously a reduced rating to neutral. So new target price is 38 cents versus the old one of 34 cents. Last close was 38 cents. Right now it's trading at 38 and a half, which is around the region of where we want it to be. So now what is also important to note is civil engineering segment, just this segment alone cannot sustain dividend payments, or at least dividend payments from how much it was paid out last year. At this point of time, net order book is at $973 million and it will last all the way to 2020. $963 million includes the new project that they have clinched in August 2016. So why do I say that? Why are we just focusing on civil engineering segment? Because property development will not give any contribution at all until 2018, simply because of the differences in the recognition of revenue for industrial property. And again, just a bit of recap here. Hock Lian Seng is currently developing Shine at Tuas, which is industrial property. Industrial property recognizes revenue upon handover, and handover cannot be done until the completion of its construction in 2018. So much about civil engineering and property development. Now we move on to its balance sheet. What's good to note here is the cash has ballooned to $202.6 billion, and it's the highest since its IPO in 2009. Although cash has ballooned, we are in the opinion to think that it's very unlikely for them to use this cash for significant acquisitions in the near term, simply because most of this cash is required as for working capital for the civil engineering projects. And next thing is, of course, the development of Shine at Tuas. So with that in mind, most of these cash will be used for these two segments. So there won't be too much leeway for them to use the remaining to do any significant acquisitions, or at least to maintain historical dividend payouts. And finally, for Chip Eng Seng, okay, again, they've reported the results last week. and overall the results was mixed. So revenue dropped 14%, and at the bottom line it dropped 58%. So what has contributed to the drop in revenue is mainly because of the scarcity in property development contribution. So again, a bit of recap here. Previous development projects, most of them were handed over in December 2015. So right now, apart from Fulcrum, which is a 128 unit development in Fort Road, plus High Park Residences, which is left like 5 or 6 units, plus a small gross development value property development in Australia. They have nothing much on hand. So good or bad here. The good, I mean, depends on how you look at it. The good thing is that they having too much inventory may be a suggestion to say that they have inventory stuck on their hand right now. But for but moving forward here, what we should focus on is that the development fulcrum is 41.4% sold versus last quarter, which is around 39%. So essentially, they move only a couple of units within this quarter. And why is it so? Is that we shared this before, and we talked about this is because of the larger size units in this development, followed by the higher asking price that they are going for. And then again, the next question is that why are they not cutting prices? And they are not cutting prices because they simply don't need to cut it at this point of time. Because QC is only due in March 2018. While it might look like they are left with 58%, I mean 58% might look like a huge percentage. But 58% mainly only refers to like 60 or 70 units on hand. And right now, what's good to note is that most of these large units have already been sold. So it's left with those smaller units which are higher price. In a way, what is a higher price is that in a development, the bigger units usually sell at a lower average selling price compared to smaller units. So they're just holding on to the smaller units. And why is it so? Is that they are quite adamant at this point of time. They are not willing to cut prices until there is an urgency to do so. So in third quarter of 2016, average selling prices came in at 1,907, and at the end of the day, what is important to note here is that our estimated average selling prices is $1,600. Is still significantly higher than our estimates. And again, why is this such a large deviation? Is that we want to maintain a conservative stance on projecting average selling prices. So anything higher is definitely a bonus. And for the remaining 58.6% of the development, it will contribute approximately 1.3 cents to our RNAV projections. Now, so much about Singapore. Let's move on to Australia. And in Australia, Willow Apartments is a small GDV project. Right now, they are left with around less than 50% unsold. So in order to boost its average selling prices, they are actually consolidating these units to make them into a bigger size units. So why we think that sales will improve moving forward is that down payment required for this development is actually reduced to 5%. Previously it was 10%. So essentially you just need to, for a home buyer in Australia, you just need to come in half the amount, down pay half the amount, and they are able to finance the property. So next, Tower Melbourne. Litigation issue unfortunately is still ongoing. But again, I'll just remind everyone here, we continue to exclude any development profits from Tower Melbourne until there is some certainties that we can derive. So next is that Tower Melbourne is 100% sold at this point of time. But we do not include any development profits from this development. But if in the future, if you are able to get certainties from it, it will add a potential 12 cents to our RNAV. So for Chip Eng Seng, we maintain a target price of 72 cents. Last close was 62.5 cents.
Hi, good morning, everyone. This is Richard speaking. Okay, so I'll talk about 4 companies that announced their results last week. First, 800 Super. Okay, we have upgraded from neutral to accumulated target price 92 cents. Actually, today already hit 91.5 cents intraday. Last close last Friday was 74 cents. So just run through quickly the results was revenue was up only by 3.6%, but EBIT year on year was 38% higher, mainly due to cost control for their operating expenses. Year on year operating expenses was the same, 34 million this year versus 34.1 last year. So more of the increase in revenue was accrued down to EBIT level. Operating margin also improved from 10.4 last year to 13.8 for the first quarter year on year. And so all these flowed through to the bottom line. And so PATMI was up 40% year on year for the quarter. So the few bullet points that we have is insider buying. So earlier last month, they have announced on the SGX website that this Yongxiong Investment Private Limited, which is mainly owned by the brothers who run 800 Super, they control about this Yongxiong Investment controls almost 67% of 800 Super. Sorry for the typo here. This should be expect, not accept. Okay, then nothing new here. Waste to energy plant and material recovery facility project. These have been ongoing and shouldn't come as a surprise to any of you. So waste to energy, this plant projected to complete second half of 2017. We think that it could be third quarter of 2017, i.e. The earlier half of the second half of 2017. For MRF, construction is to commence in first quarter of 2017. So we recently attended the AGM for Super last month. Something to add on for waste energy. At this point in time, they say that it's going to be a 4-story building. The piling for first story has already been completed already. Next bullet point. So you may have read in the news that the refuse collection fee will increase by about 10%. Take note that this higher fee will not accrue to 800 Super because this fee that you read about in the news is the fee between NEA and household. It's a different contract from the one with NEA with 800 Super. For this time around, we have increased our PE to 9 times, previously was 7.5 times. The reason why it increased is to bring it in line with its sector peer Colex and also with the visibility in improved earnings. So we use a next 12-month EPS of 10.24 cents and that gives us a target price of 92 cents. Also, with the improved earnings, we have kept our payout ratio assumption the same. I think it's 30%, and that results in a potentially higher dividend again this coming FY due to the higher earnings. Moving on, Cogent. So Cogent announced the results last Friday evening. We have published a report this morning. We still maintain buy, target price unchanged, and we are forecasting 2.31 cents dividend for the end of this year. So much like Super, there was a modest increase in revenue, but EBIT year on year was quite significant change, again due to lower operating expenses. So for Cogent, if you're following it, you have heard me say before several times already that their logistics facility, they are consolidating all their operations into one logistics facility. So they will be replacing rental expense with a fixed straight line depreciation charge. So for this quarter, their operating expenses was $217,000 lower year on year, or marginally is just 1% lower. But because of this low base, it actually improved the EBIT line by 14%. Margin also improved to almost 30% from previous of 27%. That's a 3 percentage point improvement. So all that flowed down to the bottom line, and so net profit was 13% higher year on year. Net margin also improved to 23% from 21%. So I've talked about this before. So their upcoming project, the Jurong Island Chemical Logistics Facility, is a 3.5 hectare site on Jurong Island. The land already has been officially handed over to Cogent earlier this in the middle of last month, and they are already starting work with the consultant and authorities for phase 1 of the project. So as I've said before, this new facility will be about the same size as the existing Cogent 1 logistics hub on the mainland Singapore. And to give you a sense of perspective of the size of this logistics hub in terms of GFA, is slightly larger than the GFA of Vivo City. So margins expansion driven by sustainable cost control measures. I mentioned this before just earlier. They are replacing rental expense with depreciation charge. They have consolidated some of their previous sites at different warehouses into their logistics facility, so they have managed to reduce their rents. This quarter, year on year, it was primarily lower rental expense, which was the largest contributor to the lower operating expenses. They can derive some more savings probably either the end of this year or early next year. Sorry for the typo here, so it should be early 27. Sorry for the typo here, it should be early 2017. So ongoing, they have this issue with their rooftop container depot at their logistics hub. The issue is with their crane, so the overhead crane system. So once that issue is resolved, they will return the land that they're currently using for their old container depot facility. That will be returned to JTC, and they will save on. They'll make further savings on rental expense again. Probably full quarter effect will only happen in first quarter or second quarter of next year. Okay, technical wise, this time we have decided to share some technical for this counter as well. So you can see for the up move, it has already retraced to one of the Fibonacci levels. So this could be an entry point here for buying near technical support level. ComfortDelGro next announced their results last Friday. We've upgraded to buy, and but target price has been lowered to 292 from previous target price of 319. To summarize, just take a look at the revenue here. Revenue was lower year on year by 3.1%, but this was mainly due to unfavorable currency translation, whereas at the EBIT level there was favorable currency translation because while revenue is in foreign currency, their cost for their overseas operations is also in foreign currency, so there will be a favorable translation for the expense side as well. And so for that EBIT, decline in EBIT managed to close the gap between 3.1% and 1.4% here. And finally flowed through to bottom line, and they still managed to make a 2.5% year-on-year growth in their net profit. So now, next slide, we'll focus on their three largest business segments, which is bus, rail, and taxi. So for bus, first it says SBS Transit is stable, upcoming contract renewals in UK. So as you're aware, the public bus system in Singapore has already transitioned over to the bus contracting model that was effective on 1st September. So for SBS Transit, quarter-on-quarter profit and margins were stable, but now there's a higher trade receivables due to timing difference of fee payments. So in the past, if you recall, the fare collected will be collected as soon as you bought the bus. So that's why they can recognize the revenue and they get the cash within. There's not so much of a timing difference here. Whereas now under the contracting model, they do not collect the revenue anymore, and they after they recognize the revenue, there's a lag when they get the payment from LTA for the service rendered for the bus service. Now for UK side, management also said that there will be some renewals, upcoming renewals in UK side, but they're expecting lower rates. However, frequency is expected to increase for the services, so that would even out the lower rates by having higher volume. Taxi, so in Singapore, taxi hire rate is at 99%, which is almost full. Usually there will be some spares for when there are other taxis that are being serviced, so that they can still lease out the spare taxis to the hirers. Management also said that there's ongoing replacement from Sonata fleet to the I-40, and this is expected to lift revenue for the segment due to the higher rental rates of new taxis. For taxi fleet expansion as well as taxi renewal, fleet renewal or buying new taxis, this will be guided by COE prices and competition from the private car hire services. The operating landscape in China for their taxi is also improving, because they say that authorities in the major Chinese cities are starting to impose rules on the private car hire taxis, and this has a bad effect of actually benefiting the incumbent traditional taxi operators. Lastly, rail. So as you're aware, it was announced by Public Transport Council that there will be a 4.2% fare reduction end of this year. The only segment for ComfortDelGro that is affected by this is the rail segment. So at the moment, downtown line is still unprofitable, but we are actually most upbeat about the downtown line at the moment, because it actually has a visible pathway to revenue growth that will lead to profitability. So you know, when downtown line 3 open, revenue will grow again, and because now they're incurring the sunk cost, that's why it's not profitable, but once you reach steady state, it is going to be profitable. And LTA projects that the full ridership for the whole downtown line will be about 500,000 passengers daily. That is more than double of the current 234,000 for downtown line. So you can see that this doubling in ridership will more than outstrip this 4.2% fare reduction. Okay, lastly, for valuation for ComfortDelGro. So if you look at the chart here, actually the stock had re-rated after the government had announced the bus contracting model in May 2014. So at this present moment, after re-rating, the average PE has been 20.6 times. Our implied forward PE based on our target price is actually 19.7 times, which is even lower than the average PE. And right here, the current PE is 16.9 times, which is already even lower than -2 standard deviation PE of 17.5 times. So to conclude, we actually have re-upgraded ComfortDelGro to a buy. Okay, sets. Sets we have maintained neutral. Target price, we have raised it slightly to 448. Last close on Friday was 479. So here, revenue, you can see there was a slight improvement year on year. This was due to better revenue from solutions and gateway services. EBITDA margin here, year on year improved because the increase in revenue outpaced the increase in variable cost. Likewise for EBIT also, and bottom line was slightly impacted because of the lower contribution from the gateway services JVs. But all in all, the 3.7% year-on-year increase in revenue translated to a 4% increase in net profit. So for TFK Corp is their Japanese subsidiary that's operating in Tokyo at the Narita and Haneda Airport. So last quarter it reported a profit for the subsidiary, which is the first time in about 2 or 3 years. It has been loss making for quite some time. So there was a turnaround last quarter, and it has remained profitable again in this quarter. So we're expecting to be maintained. This quarter it was, or rather, the factors that contributed to it remain profitable since last quarter was the higher volume and strengthening of Japanese yen. So, this first bullet point is reasons for the higher revenue is because of higher volume and the strengthening of Japanese yen. So now, the higher volume came from the Delta Airlines contract, and also their flight kitchens are being used to service non-aviation customers as well. So they are actually having some economies of scale at TFK, and they have managed to remain profitable. SETS, the next SETS e-commerce air hub. So that's the next project in their pipeline that is materializing. So it has been completed already, but they are undergoing testing, and it will open in the early part of 2017. So if you have followed their media release, Seng, their joint media release, SingPost is becoming the anchor customer at this e-commerce air hub. What's happening is SingPost is not renewing their lease for their own hub at the airport, so they're going to become a customer to SETS. You may also have read in the news that Amazon is setting up a base in Singapore as well. At this point in time, SETS does not have a contract with Amazon, but of course they are hopeful on becoming a partner with Amazon as well at this air hub. One new change this quarter is that they have increased the interim dividend. So interim dividend has been increased to 6 cents. Historically has been 5 cents for the last 6 years. So management again reiterated their dividend policy of paying a progressive and sustainable model. The other change is that is in the way that they are going to present their operating statistics. So in the past, they reported their operating statistics on a quarterly basis and focusing solely on their Singapore aviation business. Now, going forward, they will report on a half-yearly basis, and it will be on a regional basis and not Singapore only. So this will only be for their subsidiaries and will not include the data for their joint ventures. I'll just go through line by line what these numbers actually entail. So for passengers handled, this is for their aviation passengers in Singapore and Hong Kong, and the cruise passengers at the Marina Bay Cruise Center in Singapore. Flights handled will be obviously flights will be aviation. It will be the aviation customers in Singapore and Hong Kong. Cargo processed is solely Singapore only. Gross meals produced will be everywhere. That will be Singapore aviation. That's the in-flight catering. There's in Japan, TFK Corp, which is also catering, in-flight and non-aviation catering, and as well as institutional catering locally, like such as the SAF camp and schools and universities. Lastly, ship calls handled. This is specific only to Marina Bay Cruise Center in Singapore. Okay, we'll move on to FNN.
Good afternoon, everyone. I'll just give a brief update on FNN. Since our last updated a report on FNN on our forecast and assumptions back in September. Yeah, so as the title said, they saved the day, but cloudy prospects ahead. As you can see that the top line is actually as what we have expected. There's a decrease of about 6.7% on the top line. This is actually in line with our expectation of 6.1% slowdown. We have actually factored in a subdued top-line growth for FY17 as well, on the back of cautious consumer spending in Singapore and particularly in Malaysia as well. So the core markets, including Singapore, Malaysia, and Thailand, we don't really, because of the macro headwinds, and particularly when we see there's a currencies free fall last week, on Friday itself, we think that it will continue to weigh on consumer sentiment. And as later I will briefly bring you through on the breakdown of respective geographical area as well as different segments. Nevertheless, let me sum up that from here you can actually see that the main contribution for its top line is only from dairies. The negative growth was mainly due to a weaker foreign exchange translation. So for all this, for dairies as well as beverages, it was affected by the weaker ringgit, competitive pricing in Malaysia, and a slower volume growth. So for competitive pricing, right, we still expect that FNN couldn't pass on the increased cost to its end consumers. And by increasing costs, what I meant is the increasing sugar prices. And to that, I would like to bring your attention to dairies. We know that dairies are actually supporting its EBIT margin. Although that we can see that the top line is not growing for the dairies, but the bottom line is actually expanding and supporting the overall PATMI. So it has dairies EBIT margin is actually at 10.8%. So at about 11%, growing from 6% in FY15. We do not think that this double-digit EBIT margin would be able to sustain. The only contribution for dairies that is actually coming from Thailand's dairies, because for Malaysia's dairies, most of its sales driver is actually the sweetened condensed milk, and the main component for sweetened condensed milk is actually sugar. Management shared that their milk commodity prices are actually well hedged, so that's not one of their concern, but the concern is on sugar prices. Sugar prices, they are only price takers, and sugar prices have been on an increasing trend due to a global short supply. So industry-wide, they are actually expecting that this short supply would extend to at least end of 2017. So we do not think that dairies EBIT margin will continue to sustain at this high level. Another point that we are still maintaining our reduced call is that because we are still waiting for the potential re-rating catalyst, which I am actually referring to the acquisition of Vinamilk and Sebaco. These two deals are still on the table, but the Vietnam government has not actually laid out a concrete timeline yet. Last but not least, F&N management actually proposed a lower dividend this year as compared to FY15. So it's 10% lower at 4.5 cents per share. Thus, sharing that the lower dividend payout is because that they are trying to conserve capital for potential acquisition. So although that they are cash rich, knowing that they are actually saving their cash for potential acquisition need, in particular Vinamilk and Sebaco, we do not think that it would increase its dividend payout ratio. It should be maintaining at up to 50% of its earnings, as per what its dividend policy say, or the most optimistic wise would be sustaining at 4.5 cents. So we are going for a more optimistic point. Our assumption actually assume that F&N is going to sustain its 4.5 cents dividend moving ahead. So as mentioned just now, I've actually summarized these two tables where you can actually look into respective segments in terms of sales growth, volume growth, and we also break it down to a geographical region as well. So you can see even in constant currency and in the Sing dollars term, Malaysia is not doing well, and you know that Malaysia is actually sole contributor to F&N. Volume growth, as mentioned just now, is still very slow. And for beverages, F&N management actually shared that if the sales volume for beverages actually hinges on F&N's 100 plus sales. So if F&N 100 plus sales is not going to grow, then we would likely to see a very low single-digit growth coming from beverages side. As mentioned just now, with knowing that margin for dairies would not be sustainable, and knowing that its volume growth should be quite flattish, we think that dairies would not be able to sustain, would not be able to support FNN's both top line and bottom line growth. Hence, we're actually maintaining our reduced call with a lower target price at $1.70. Our previous target price is at $1.93. Just to share with you on some of the peer comparison with FNN. So as you can see that FNN is currently trading at about 29.6 times forward PE, which is about 67% premium to its Asian peers. That's oh sorry, this is 17.2. Yeah. So with a lower ROE as compared to its peers, these two metrics actually supports our thesis of reduced rating, knowing that there will be a lackluster growth, knowing that there's no absence of significant growth catalyst moving in near term. Hence, we maintain our reduced call. Next, we'll move on to Singapore REITs.
Hi, this is Richard again. Okay, so last Friday we published a sector report on industrial REITs sector. I'll just go through some of the things that we talked about in the report now. Okay, so outlook. I don't want to go talk too much things again. Outlook-wise, almost no change from the last quarter's sector report. Key change here is this one here where we say slight negative bias for business park rental reversions are on the cards. Most of these points here is exactly the same. Here, exactly the same also. We are still underweight on industrial REITs, and we maintaining equal weight on the S-REITs sector as a whole. So what that means is within S-REITs, underweight the industrial REITs. So here is just reproducing the data from JTC. Nothing. The visually all you need to see is most of the arrows are red, but I'll go into more detail for each of them in the next few slides. Okay, so key takeaways from this quarter. Again, first two bullet points are the same, no difference. Leasing market remains soft, even data center segment saw weakness. Second bullet point, tenant retention is paramount. These are exactly the same bullet point from previous quarter. So I'll just go into more detail here. So among the industrial S-REITs, generally negative reversions were seen across the portfolios because oversupply condition persists only, to give you an example, even Capital DC REIT had to give an 8% reversion to a large client in their data center. So this large client takes up quite a bit of space in Capital DC Singapore 2, this formerly known as T25, and this particular client also has presence in various properties within their portfolio. Now, next point, tenant retention is paramount. Same thing, is nothing more to say. Okay, this is a new one where we say mindful of downward revaluation of properties. So in this quarter, we've seen that for Cash Logistics Trust, one of their properties, the Schenker Mega Hub, I think it's a 51 Alps Avenue or 71. It has been revalued downwards because of their ongoing dispute with that tenant. So noting also that another REIT under our coverage, which is Soybuild REIT, they're also currently facing a tenant dispute for their Technics offshore property. So we are getting investors to be mentally prepared for a revaluation downwards for that property in Soybuild as well. Other candidates for downward revaluation at the end of year, take note, end of year, so December, I'm referring to the December end of year where the REITs who have their financial year that ends in December as well, there are a number of them, so they will do a revaluation of their properties. So other prime candidates for downward revaluation will be those properties with conversion from master lease to multi-tenancy lease. So what's the big deal about this downward revaluation? So for downward revaluation, overnight there will be a loss in NAV because of the revaluation downwards. And then what happens is that in terms of gearing, the asset side becomes a lower. So but the debt still remains the same by dividing by a lower asset base. So gearing gets pushed up just by this downward revaluation, and then when you've got higher gearing, acquisitions become more difficult. And yes, so now here no change, again maintain equal weight and equal weight on S-REITs and then underweight on industrial subsector. Okay, so this table here shows our coverage list. Cash, reduce, Capital DC, accumulate, Mapletree and Soybuild neutral. These are the target price. Take note the last close price is last close as of our report, not last close on Friday. Okay, so I'll just go into a little bit on the big picture for each of the 4 industrial REITs within our coverage. So firstly, for cash, the key theme that we are saying is cautious of possible overhang of warehouse space, maintaining reduce. We think that warehouse situation is going to be worse in 2017 compared to 2016. Specific to cash, a bit on drilling down on the details, they have 27% of leases expiring in FY18, and majority of that comes from the master lease of CWT Commodity Hub. Yes, they have an ongoing rental dispute at 51 Alps Avenue. This is a Schenker Mega Hub. The property was revalued 31% downwards, and as a consequence to that, gearing was pushed up from 39.8 to 41.2 overnight. So, okay, this one you can see for yourself. Capital DC. So Capital DC has some ongoing acquisition. One is the Wales, the one in Cardiff, Wales, which they announced in October. No, sorry, they've completed that already. Then they have the ongoing acquisition of the one in Milan, which they have announced in August. And the other ongoing acquisition is for 90% interest in Capital DC Singapore 3, which is formerly known as T27. Recently, the EGM was held last week or so to get unit holder support to purchase the property from the sponsor. So our forecast for near-term forecast DPU is slightly higher than consensus. Mapletree Industrial, we have neutral. What's going on for them is that they have already obtained their TOP for phase 1 of their Hewlett-Packard build-to-suit project. They're expecting to get the phase 2 TOP in another 6 months' time. The other ongoing project is their Kallang Basin 4 cluster AEI, due to be completed first quarter 2018. Their property currently is 0% pre-committed, and management says that they probably can only get some visibility 6 months before it's completed. Our forecast near-term DPU is in line with consensus. Lastly, for Soy Build. So Soy Build, there's stability in their master leases, but currently concerns is that it's being weighed down by the ongoing tenant dispute at Techniques Offshore. So as I said, no master leases expiring in 2017. Next one will be in August 2018 for Solaris, which is their business park property at One North. So there's some concentration risk for 72 Loyang Way, which is Techniques Offshore. This contributes about 7.6% of their portfolio gross rental income, and it could be revalued downwards. Our forecast is lower than consensus expectations. Okay, actually we are running out of time, so I'll need to move a lot faster. As I explained in one of the previous webinars for the industrial REITs, we don't look at the year-on-year change in rental index. You should look at it 3 years ago, because industrial leases are typically for 3 or 4 years. So you look at this kind of time frame, and that will give you a indication of what kind of reversions, rental reversions happened. So from here you can see that in this quarter, 3 quarter 1/6, you compare with 3 quarter 1/3, it's obvious that reversions were negative. For factory, you look at a multi-user one, same story as well. From 3 years from today, third quarter this year and 3 years ago, reversions were negative. Business park, okay, for business park, you can see that roughly is flat, but going forward in fourth quarter 2016, we think that it could be negative. There might be some negative bias, because if you look compared with this one, this point here, fourth quarter 2013, it's quite likely that revision will be negative already. Here for warehouse, is also fourth quarter of this year looks like it's going to be bad. If you look 3 years ago, this is the point you should be looking at. That was the peak of the rental index as well. So so you can expect that fourth quarter is going to be have negative reversions for the warehouse segment. Okay, so here, what thing to note here, the blue bars here in this chart over here on the right, the blue bars, for the chart on the right, the blue bars show the new space that was added during the first 9 months of 2016, and the orange bars show the expected supply that will be added in the fourth quarter of 2016. So you can see that for multiple user factory and single user factory, there's going to be an onslaught of space. Almost half of the whole supply of 2016 is coming in just 1 quarter, the fourth quarter of this year. Yeah, so there's going to be an onslaught of supply in fourth quarter 2016 for factory space. For warehouse, no change from our previous quarter. We said that warehouse going to be worse in 2017, is going to be worse than 2016. So for 2016, there's going to be about 690,000 square meters of new space, and in 2017 that will be 30% more, at about 900,000 square meters of new warehouse space. So if I scroll back to the previous slide, warehouse, and you look here, you can tell that it's a no-brainer. Next year, 2017, is going to be worse than 2016 for warehouse. Okay, so some uptick in manufacturing indicators, but this could lead to higher demand for space, but it remains to be seen if these expansionary activities are sustainable. Okay, I will have to skip this due to time. I've actually talked the broad thing of all these few bullet points during the presentation. Like here, I talk about 4Q, all the supply this year is coming in the fourth quarter. 2017 going to be worse than 2016 for warehouses. Negative bias for business parks for reversions as well. Okay, so strategic top-down view. Obviously, we're negative on industrial REITs due to oversupply of space, and now at this time, we're also sounding the warning for year-end valuations to come down for certain properties within the portfolios, and this is not so. This is for those which have their financial year ending in December. So what to be invested in? So same as last quarter, exposure to REITs with strong underlying demand drivers and ability to ride out oversupply situation or visible pipeline for inorganic growth. So we have two, Capital DC REIT and Mapletree Mint, which is Mapletree Industrial Trust. So Capital DC REIT, we have still have an accumulate rating. They have a unique portfolio of unique asset class of data centers. After their preferential offering, their gearing is going to be low at 27.7%. Mapletree Industrial, although we have a neutral, but supply demand is bears the full brunt of the Singapore supply and demand dynamics, but its gearing is still low at 29%, and this will give them the firepower for inorganic growth. Sorry, let me pause here first. Okay, actually really sorry, but we have to end the webinar now because there is another webinar going on, and the account for the webinar needs to be used for the start of the other webinar. So I'll just end off by saying, end off with these last two slides here. So this is the relative valuation table. At the bottom right corner, you'll see the same table from 3 months ago, a quarter ago. Take note, price to NAV here has come down to 0.99, average price to NAV 0.99 from previous 1.01. Trailing yield has come down to 8.1 from 8.3. So when price comes down, all things equal, yield should go up, but you see that yield even came down as well. So what this tells you is that during this quarter, DPU return has actually not kept pace with the decline. DPU has come down, and the decline in price has outpaced that decline in DPU, or rather, DPU didn't keep up with the trailing DPU. Here, this is a comparison. This is 10 November and 3 months ago, 11 August. This was from our previous slide as well. So the thing is that in relation to the previous slide, so what has happened is that all these points here have come closer to the origin here, because yield came down and price to NAV came down, so they're all gravitating towards this corner. Okay, we have come to the end of the webinar. Really sorry, but for this week we will not be able to take questions live because there's another webinar and the account is used for the other webinar. But we will still respond to your questions if you email to our email address, which is research@phillip.com.sg. Also, last reminder here, this is the new address for our archive webinars. Yeah. So if you have questions, please email us at research@phillip.com.sg. If you didn't get that down, you can find that address at the back of our reports as well, research@phillip.com.sg. Yeah, so really sorry to have to end the webinar right here without taking any live questions, but we'll still reply to your questions. Okay, so see you next week. Thank you for attending and see you next week.